Dear students, in this video, will learn how to calculate income tax liability. So first of all, when we want to calculate income tax liability, we should know that what types of sources of incomes are available. So in this exam, the income tax sources can be classified into three types. First one is a non-saving income. The second one is saving income. And the third one is dividend income. So that means that in UK, if a person is earning income in its personal capacity, there are three classification: non-saving income, saving income, and dividend income. Now, how will you identify that certain types of income will fall in which category? So if the income is interest related, for example, you are earning interest from any source, unless it's an exempt income, then you will classify that as saving income. And if you have invested in the shares of a company and you are receiving the dividend from that investment, then it's classified as dividend income. And other than that, other than interest income and dividend income, whatever source of income which is taxable in nature is to be classified as non-saving income. So, such as employment income, if you are working somewhere; business income, if you are running your business as a sole trader or as a partnership; and property income, if you are in a business of renting your property. So after classification of income, in order to calculate income tax liability, we have to use a pro forma of income tax computation. So let's see that pro forma. In this pro forma, we have three columns. The first one is a non-saving column, then a saving income column, and then dividend, and finally a total column. So whenever you have to calculate income tax liability, so you have to consider these three column approach plus a total column. And then you will list down all your available source of income, that is taxable income, that is taxable employment income, which is to be in this category, and then other income, and then classify it accordingly: property income, interest income, and then dividend income. So all sources of income, you have to just list it down in the relevant column, and after that you have to total all of the column, and then you will find a total income, and that is the total income, total non-saving income, total saving income, and total dividend income. But this total income is not taxable. You will get some relief, uh, so that you can deduct that relief, and after deducting that relief you will get net income. The relief will be we'll discuss later on that how much type of relief is available. So after deducting relief, you will get net income, that is net saving income, net non-saving income, net dividend income. But tax is not calculated on this income as well. And after that, you have to deduct a personal allowance from your income. You will deduct personal allowance from your income, and you will get a figure of taxable income. This is the ultimate value that you need to apply tax rates. So after deduction of personal allowances, you will get taxable income. So in our case, this is taxable non-saving income, taxable saving income, and then taxable dividend, and this is total taxable income. This total taxable income is very important, because through which we will identify the person's type of band, that what is the band available. After that, you will calculate income tax liability using the tax rate which will be provided you in the exam. So assuming we have calculated our income tax liability on the basis of the available taxable income and the given rates. But in this liability, we will get some relief as well. We will deduct few reliefs that we will be discussing about. Marriage allowance, if there is any marriage allowance, you will deduct that marriage allowance. If there is any double tax relief, obviously this double tax relief will be available on overseas income, and after deducting that, then you are liable to pay this income tax liability. But if you have paid your income tax in advance, such as in the case of employment, you usually pay advance tax, then you have a right to deduct that advance tax as tax credit. And after that, if there is any amount payable, then it is a tax liability or the tax payable amount that you have to pay the HMRC. And if that amount is negative, then in some cases you will get the tax refund, that is tax receivable from HMRC. So this is the basic pro forma that you have also learned in your TX exam, and similarly this is also applicable in advanced taxation exam. Later on we will add a few things in this as well. So this is a basic pro forma first of all. So now you need to identify that once you have identified the taxable income, you should apply the tax rates. And don't worry, these tax rates will be given you in the exam. But as there are various tax rates, you should understand how to apply these tax rates. So let's see what type of tax rates are there and what type of income are there. In UK, as far as the income tax is concerned, the tax system is based on progressive taxation system. What do you mean by progressive tax? Progressive tax means that as the income increases, your tax rates also increases. That means you have to pay a tax rate on lower income, and if your income increases from that threshold, you have to pay higher rate on that particular income. So in this category, you can see that we have first of all income level, and then tax band, and then the type of income is being given. So in UK, if a person is earning 34,500 pound up to 34,000 pound, remember that is a taxable income. If its total taxable income is up to 34,500 pound, then the person is classified as a basic rate taxpayer. And if the person is a basic rate taxpayer, its non-saving income is taxable at the rate of 20%, so as the saving income, but the dividend income is taxable at the rate of 7.5%. But as his income increases, so as the tax rate. So if a person's total taxable income falls in this range, that is up to 1,50,000, then the person is classified as a higher rate taxpayer. So what it means? It means that up to 34,500, the tax rate will be 20%, but additional income attract additional tax rate. So for example, up to 34,500, the tax is at 20%, but on additional income, you have to pay, if it's a non-saving income, then 40%, almost the double. And then saving income, again, the double amount, but on dividend, you have to pay 32.5% on excess income. And if the person is wealthy enough and its income increases from 1,50,000 with no uh, range, or you can say that 1,50,000 or above, the person is classified as an additional rate taxpayer. And due to this, its income tax rates are now 45%, similarly 45%, and on dividend, the maximum rate is 38.1%. And now, one more thing, that is a saving income nil rate band. You have been provided this in the text sheet as well, the nil rate band. So what exactly the concept of nil rate band? Nil rate band means that certain income is to be applied at a rate of 0% tax. For example, here it has been given that if you are earning saving income and you are a basic rate taxpayer, so first 1,000 of your saving income would attract a rate of 0%. Above we will be dealing about that the rate of saving income is 20%. So if a person has 10,000 saving income, taxable saving income 10,000, so that means he's a basic rate taxpayer. So its first 1,000 of saving income would attract 0% rate, and the remaining saving income would attract a rate of 20%. Similarly, if a person is being identified as a higher rate taxpayer, how we can identify? Its total taxable income is more than 34,500. Then its saving income now, instead of 1,000, its saving income of first 500 would attract a rate of 0%. And if that person is become an additional rate taxpayer, then there will be no saving income nil rate band advantage. It's only available for basic rate taxpayer and higher rate taxpayer. Similarly, there is also dividend income nil rate band. So if a person is earning dividend and irrespective of the level of income, the level of band, whether it's basic rate taxpayer or additional rate taxpayer, everyone will get 2,000 dividend income nil rate band. It means that your first 2,000 of dividend income would be applied at a rate of 0% tax rate, and afterwards your remaining dividend income would depends on the band. And if you are in a first band, then the remaining dividend income would be 7.5, then 32.5, then additional 38.5. So these nil rate band is very useful, and in terms of tax planning, in terms of availing personal allowances, you have to consider this saving nil rate band and dividend nil rate band. As you see in the pro forma, there is a personal allowance. So after deducting relief from the net income, you will deduct a personal allowance. What is this personal allowance? In UK, every individual has a right to claim 11,850 as a personal allowance, and this is considered to be a tax-free income. For example, if a person is earning income up to 11,850, then he or she has a right to deduct this 11,850 from the income. And if income exceeded after this personal allowance, then there would be a taxable income. And if net income is less than personal allowance, then there is no taxable income, so there will be no tax liability. So this personal allowance is very important and very significant. But this personal allowance is available for all, but it also depends on the level of income. So if your level of income is more, it's greater than 100,000, then this personal allowance might be lost. In some cases, it will be a reduced personal allowance, or in some cases, it will be a zero personal allowance. We will discuss later on, that how to calculate personal allowance if the income level exceeded above 100,000 threshold. Now let's practice few basic examples so that you will be familiar about. Assuming employment income is 41,850. So assuming a person is having just one type of income, so we can classify that type of income as a non-saving income. As there is no other source of income, so no need to prepare a detailed pro forma. Just find out the type of income, that is employment income. We'll see how we'll apply tax rates. So employment income is 41850. There is no relief, so relief is not there. So we'll deduct this, and 41850 becomes our net income. So in order to make it taxable income, we'll deduct personal allowances, and these personal allowances 11,850. So after deduction of personal allowances, 41850 minus 11,850, we'll get a figure of 30,000, and this 30,000 is the taxable income. So if the income is under 34,500, so this person is considered to be a basic rate taxpayer. Now you have to apply the rates. So let's see the rates. Rates are a basic rate taxpayer, and if there is non-saving income, then the rate is 20%. So it's now very easy. In order to calculate the income tax liability, 30,000 is the income and the basic rate is 20%. So that is income tax liability of 6,000. Now let's move to another example. Now in this example, we have employment income of 21,850 and we have another source of income, that is interest income of 10,000. Now we have two sources of income and you have to find out income tax liability. So it's better to prepare a pro forma so that we can calculate it easily. We can calculate without pro forma as well, but to start with, we have to prefer a pro forma, that is non-saving income, then saving income, and then the total income. So we have employment income. Employment income is 21,850, and we have interest income, and this is 10,000. So the total is 21,850 and 10,000, and the total is 31,850, and that shows that the person is still a basic rate taxpayer. As we have no relief, so this is total income. Relief is 0, so we'll directly deduct a personal allowance of 11,850. I have deducted this personal allowance from non-saving income because we are using this as a most beneficial way. So out of 21,000, 11,850 will get a figure of 10,000 and 10,000 interest income. The total taxable income is 20,000. That shows that it's a basic rate taxpayer situation. And now this is taxable income. Now, income tax liability. Now we have two sources of income and the rates are different on non-saving income and saving income. But for the basic rate taxpayer, the non-saving income attract 20% as well as saving income. But you have to consider the nil rate band available for saving income. So let's compute income tax computation. So first of all, we'll apply a rate on this order, first on non-saving income and then on saving income. So our non-saving income rate would be 10,000 and the basic rate is 20%. That means your income tax liability against this is 2,000. Now we have covered this non-saving income, now the saving income. But as you know that the saving income nil rate band is also there. And in case this person is basic rate taxpayer, so nil rate band is available on first 1,000 and it would attract a tax rate of 0%. Now this is the application of the rules. First of all, I told you the rules and now I'm applying each rule. So the other saving income, that is other than nil rate band, whatever is the source of income. So this total was 10,000, deduct 1,000 from that. The remaining saving income is 9,000 and the basic rate of saving income is 20%. So that is 1,800. So total tax liability in this case is 3,800 and this is income tax liability.